Welcome to Lesson 3, Debt to Income Ratio. Our objectives are to understand why knowing your debt-income ratio, your DTI, is important, also to know what your DTI score means, and to calculate the DTI given income and debt. So generally we're going to be looking at, can you afford a mortgage? Can you afford to take out a loan and pay this mortgage? And banks are really concerned with this ratio as well because they are the ones lending you the money. So they want to make sure that you can pay them back. Down here, I thought this was interesting. We have average income and credit card debt by age. So if you notice that the 45 to 55-year-olds make the most money and they also have the most debt. So what it says to me is that as you're getting older and you start to earn more money as your job gets better or you get promoted, you also increase the amount of debt you have. But then at a certain point you start thinking about retirement and you either start paying off your debt or you're a little more careful about taking out loans or paying just with cash. This one over here has to do with the average income and credit card debt by education level. And again, if you'll notice that no high school diploma, high school graduate, and college graduate. The college graduate makes the most money, obviously, but again, has the most credit card debt. So people tend to spend what they make, and that's part of the reason why banks want to look at your debt to income ratio. Okay, so what is the debt to income ratio? The debt to income ratio measures the percent of your income that is paid towards debt. So you bring in a certain amount of money every month. How much of that goes towards paying your debt? Why is it important? Well, you need to learn about your debt to income ratio if you want to monitor your overall financial situation. So you need to be thinking all the time, how are you doing financially? Are you saving for retirement? Are you able to pay your bills? Will you be able to buy the house you want? Also, it's important because it'll let you know whether you qualify for a loan, whether you can earn a higher credit score, which will then qualify you for better interest rates and more money. So what does your DTI mean? Generally, if you have a ratio of 30% or less, it means you have a great debt to income ratio. It means that you have much more income than what you owe. If you have a debt to income ratio of 44% or higher, however, it means you are probably taking on too much debt in relation to your income. So you either need to increase your income, which isn't always within your means, or you need to decrease your debt. Before we had the recession, you used to be able to take out a loan if your DTI was up to 55%. But at that point, there became new standards and new regulations and new lending requirements. So now anything above 44% makes it hard to qualify for a mortgage. So it's very easy to calculate your own DTI and determine if it is under 44%. Let's look at a couple of examples that illustrate this. So again, this is on a monthly basis. So here's how it's calculated. We compare certain debts that you have to your gross income, and it's as simple as that. It's just merely a ratio. So we would take our monthly debt payments. Some examples are a house payment or a potential house payment that you're looking at having, any insurance that you pay on your house, your cars, property taxes, credit card debt, and then with that, they look at the minimum monthly payment. So what are you required to pay each month on your credit cards? Not necessarily the outstanding balance, but the minimum payment. Any vehicle loans that you may have out, student loans, child support, alimony, all that goes into your debt. So you take your debt and you divide it by your total monthly take-home income. You might be saying to yourself, well, I have other expenses too, like food, utilities, entertainment, things like that. But that is not included in the debt to income ratio. Even though you have to think about that when you're budgeting, lenders don't look at those types of things when they calculate your debt to income ratio. So in our first example, you are making $4,000 a month gross. So in other words, you make $48,000 a year. Here's your monthly obligations. You have a car payment of $400 and you're looking at having a house payment of $1,200, and the minimum payment on your credit cards every month is $250 for a total of $1,850. So to determine the debt income ratio, we would just divide our monthly debt payment by our monthly income. So we would divide 1,850 by 4,000. We would get 46%. So what does that mean? That means you pay 46% of your income to your debt. Now remember, this is a number that, or this is a percent that is above 44%. And the more debt you have, the less likely you are to qualify for a mortgage. Specifically, any debt to income ratio that's 44% or higher is going to make it difficult for you to qualify for a mortgage. Because remember what they're thinking. You do have these other expenses in your life. So 44% is the cutoff. Let's look at one more example. So in this example, you and your spouse, maybe you've just gotten married, are considering buying a house, and you need to figure out what you can afford and what a bank will lend you. So just because you wouldn't qualify for one mortgage, that doesn't mean you might not qualify for a lesser mortgage. So together, you guys are doing pretty well. You have a combined gross income of $166,988. The monthly mortgage payment for the house you want will be $1,544. And then your annual property taxes are estimated to be $2,188. And then you have a homeowner's insurance premium. That's going to cost you $1,007 per year. So these are things that are estimated right now based on what you want to purchase. Currently, you do have a $510 per month car loan, and your average monthly credit card bill is $1,100 that you pay each month. So in this case, is the bank going to loan you this $210,000 to purchase the home? So remember, they're going to look at your debt to your equity. So let's figure out our monthly debt first. So let's figure out the monthly. And again, this is going to include future debt. So this will also include that mortgage amount as well. Okay, so let's pull out our calculator. We have a mortgage, let's see, of $1,544, so that's already monthly. Our property taxes are annual, so let's take $2,188 and divide that by 12 to figure out our monthly property tax bill. And then let's start adding these up. So we have our mortgage of $1,544. We have our taxes, and again, these are our estimates based on what we want to purchase, of $182. And we'll just go ahead and round and leave the cents off right now. We also have homeowner's insurance premium, again, another estimate based on our future house. So $1,007 divided by 12 gives us, we're just again going to round to approximately $84. And this is our insurance. You have a $510 per month car loan. So we have a loan of $510. And your average monthly credit card bill is $1,100. So quite a few things that we are paying each month if you look at this. So why don't we go ahead and total this up. We have $1,544, $182, $84, $510, and $1,100. That gives us a total of $3,420. So that's our debt. That's our total debt. Now let's figure out what our income is, our monthly income. So let's look at that. We know that in the course of a year, you're going to make $166,988 combined, and they do look at the combined if you take out the loan together. So $166,988, we'll divide that by 12 to figure out what it is per month. So per month, you guys are doing pretty good. You have $13,000 916. So if we go ahead and we look at our debt to income ratio, we will create our ratio. So we'll take our debt, 3420, divide it by our income, 13,916, and the bank will say, let's see, 3420 divided by 13,916 means that you actually have a debt to equity ratio, and I'm going to round a little bit here, of 24.58%. So that's pretty good. So on the surface, it looks like you have a lot of monthly debt, but because your income is substantially higher, your debt to equity ratio is well within the range to qualify you to purchase that house of $210,000. Remember that 30% or under is great, but you really need to be 44% or under in order to be considered. Okay, so let's go back to our objectives and make sure that we are clear on our objectives for this lesson. So hopefully now you understand why knowing your debt income ratio is important, and now you know what the debt to income score actually means and what it means for you in securing that mortgage. And finally, you can now calculate the DTI given monthly income and monthly debt.